97% of all money is created out of thin air by the banks. 2008 has served as a constant reminder of how boom and bust cycles cause economic chaos, and its financial crisis has prompted in-depth discussion into the world of banking. Many different schools of economics have varying opinions of recessions. Austrians cite central banking as a primary reason, while Keynesians examine the symptomatic results of lower aggregate expenditure. But conventional wisdom has not fully realized the artificial power that is extended onto a typical bank. This is because there is confusion as to both the role that a bank plays in the economy and how money is created. We know that banks lend money to customers to receive interest as profit, but whose money is being lent? What sparked my interest and newfound knowledge into this topic was a paper called "Can Banks Individually Create Money Out of Nothing?" by Richard Werner. This paper empirically proves that banks have the ability to create money out of thin air by using accounting tricks, and features an extensive literature review of the different theories of banking that were explored by different economists. These three theories are the financial intermediary theory. Banks are only intermediaries and they are no different to non-bank financial entities. The fractional reserve theory. As banks can lend out nearly all of the money in their deposits, the banking system can greatly increase money supply, magnitudes of times larger than the money initially deposited. And the credit creation theory. Banks do not require money in their reserves to extend credit, as they can simply create this money out of thin air. The financial intermediary theory states that banks can only lend out money that is currently in their reserves, that has been inserted there by only bank deposits. To quote Paul Krugman, banks make their profits by taking in deposits and lending their money out at a higher interest rate. Of course, it is no wonder as why the neo-Keynesians are not admired anymore, as archaic ideas such as these are touted to this very day. The fractional reserve theory states that the whole banking sector can vastly multiply deposited money magnitudes in times, although individual banks can only lend money from their reserves. The money multiplier effect can be expressed by this equation and can theoretically lead to the banking sector multiplying deposits by a factor of 10. Although this theory is more profound than the intermediary theory, it however is also antithetic to the credit creation theory, as it states that individual banks can only lend money in their excess reserves, which constitutes either as deposited money from customers or money borrowed from other banks. Paul Samuelson, in 1948, argued against the credit creation theory, very sarcastically. To quote Samuelson, "According to these false explanations, the managers of ordinary bankers are able, by some use of their fountain pens, to lend several dollars for every dollar left on the deposit with them. No wonder practical bankers see red when such behavior is attributed to them. They only wish they could do so, as every bank well knows. He cannot invest money that he does not have, and any money that he does invest in buying a security or making a loan will soon leave his bank." Finally, we have the credit creation theory, which has been known by 19th and 20th century economists such as Joseph Schumpeter and Henry Dunning MacLeod. This theory states that individual banks can literally create money out of thin air, as it is created in the books via accounting manipulation. To elaborate, when loans are extended onto customers, the bank does so, and does not retract an equal amount from their excess reserves. To quote Schumpeter in Bank Credit and the Creation of Deposits, "Banks do not, of course, create legal tender money, and still less do they create machines. They do, however, something that is perhaps easier, in this case of the issue of banknotes, which, in its economic effects, comes pretty near to creating legal tender money, which may lead to the creation of real capital that could not have been created without this practice. But this alters the analytic situation profoundly and makes it highly inadvisable to construe bank credit on the model of existing funds being withdrawn from previous uses by an imaginary act of saving and then lending out to their owners. It is much more realistic to say that banks create credit. This theory holds true, and is empirically proven, in today's economy, 97% of money is created through credit creation. The issue with Joseph Schumpeter's way of thinking, however, is that he believes that it's a good thing, as banks can ultimately accelerate innovation by lending out more money to innovators in the economy. However, Chicago economists Raham and Singales commented that it is mainly venture capital funds that fund new startups rather than banks, as banks mostly tend to lend to existing firms. As the credit creation theory is very unconventional, it has prompted discussion about monetary policy and inflation. The financial journalist Hartley Withers said, "If then this quantity theory, as I believe, is mostly true, we see how great is the responsibility of the bankers as manufacturers of currency, seeing that by their action they affect not only the convenience of their customers and the profits of their stakeholders, but the general level of prices. If banks create currency faster than the rate at which goods are being produced, their action will cause a rise in prices, which will have a perhaps disastrous effect." Credit creation has been proved empirically by Richard Werner in 2014 in a research paper called "Can Banks Individually Create Money Out of Nothing?" Apart from an extensive literature review, which examines all three theories of banking, an empirical test was practiced on a German bank and on a German community bank called Raiffeisenbank Wildenberg, which was located east of the city of Ingolstadt. In this experiment, to which the directors agreed to, 200k was to be credited to an account, and the balance sheet was to be examined the next day. If the credit creation theory held, the bank reserves should remain the same, and the customer claims should increase by 200k. If the theory is wrong, the excess reserves should decrease by 200k. It was shown that the total assets of a bank increased by 178k, and the liability increased by an equal amount. More importantly, the excess reserves remained unchanged. If there were no financial activities on that day, the results would be nearly perfect to the theoretical example shown. Remember that financial services are performed every day in a bank, and so the bank had to resume its day-to-day financial operations. If banks create money out of thin air, it would imply severe consequences for the sustainability of our economy. If 97% of money is created credit, that means that 97% of money is debt, in which case it is no surprise that many countries around the world have over 200% private sector debt to GDP. My own solution is to abolish credit creation, as it contains very little upside for the economy, and to replace the responsibility of creating money, banks will create all of the money. And banks will use this money to increase the prosperity of all people, rather than having the bankers create the money. The government will create all money and give it to the people by universal basic income. I have a simple calculation that justifies my solution. If the M2 money supply is around $20 trillion today, and M2 money supply increases by around 5% every year, then $1 trillion is created every year. That could be printed by the government. That is $5,000 for every US adult, assuming that there are 200 US adults that live in America. Other economists like Richard Werner propose a reformed system where credit is only produced for productive purposes using credit guidance, like in Germany, which has a large quantity of credit unions and community banks. It is said that 70% of German banks are democratized, in which board members are democratically elected. These non-profit financial institutions offer minimal interest on mortgages and do not speculate on financial securities. Germany is proven to be more financially sustainable as the private and household debt to GDP ratio is lower than that of the US, but the economic growth has little to show for it, as it has had a government surplus many years before 2020. And remember, public surplus is private deficit. There will be debate over who should create our money supply, but one thing is for sure, 97% of money is created by the banks, who will stop at nothing to speculate on financial asset bubbles. Without restricting credit creation, our economy would be doomed to unsustainability. Capitalism, the system based on voluntary exchange, is not the cause of economic collapse, as creating money out of thin air can only be considered as a power given by governments. International finance is the ultimate menace of today's economy, and nationalization, unfortunately, does not make banking more sustainable, as seen in China, where the government forces banks to lend more money than they should. It's time to accept that we must say no to international finance, who combine the powers of government and markets to play God without permission. And thank you for watching.